Market efficiency is a foundational concept in finance that describes how quickly and accurately financial markets incorporate information into asset prices. The program explains that an efficient market is one in which security prices reflect all available relevant information, making it difficult for investors to consistently achieve abnormal returns after adjusting for risk and transaction costs. Market efficiency is important because it influences investment strategy, security valuation, portfolio management, and the role of active versus passive investing. If markets are highly efficient, prices already incorporate publicly available information, limiting opportunities for consistent outperformance through analysis or forecasting of future market movements. The efficient market hypothesis, EMH, is commonly divided into three forms: weak form efficiency, semi-strong form efficiency, and strong form efficiency. Weak form efficiency states that current prices fully reflect all historical trading information such as past prices and trading volume. Under this form, technical analysis should not consistently generate abnormal returns. Semi-strong form efficiency argues that prices rapidly incorporate all publicly available information, including financial statements, economic data, and news announcements. Strong form efficiency extends the concept further by claiming that prices reflect all information, both public and private. The program emphasizes that the degree of efficiency determines how useful different investment strategies may be in generating excess returns over time. Weak form efficiency challenges the usefulness of technical analysis, which attempts to predict future prices using historical price patterns and trading trends. If markets are weak form efficient, past price information is already embedded in current market prices, making recurring patterns unreliable sources of abnormal profit opportunities. However, weak form efficiency does not eliminate the potential usefulness of fundamental analysis because new public information may still create pricing opportunities before it becomes fully incorporated into prices. Analysts studying weak form efficiency often examine serial correlations, momentum effects, and other market anomalies to evaluate whether historical trading patterns contain predictive value regarding future security price movements or investment performance. Semi-strong form efficiency has major implications for fundamental analysis and active portfolio management. Under this form, publicly available information is rapidly incorporated into security prices, meaning investors cannot consistently outperform the market using publicly accessible data alone. Earnings announcements, economic reports, and corporate disclosures are reflected quickly in market prices as investors compete to interpret and act upon new information. The program explains that event studies are commonly used to test semi-strong form efficiency by measuring how rapidly prices adjust after major information releases. If prices adjust almost immediately, opportunities for abnormal returns disappear quickly, supporting the argument for passive investing and diversified index-based portfolio strategies. Strong form efficiency is the most restrictive form of market efficiency because it assumes that even private or insider information is already reflected in security prices. Under this extreme version of efficiency, no investor could consistently achieve superior returns, even with access to confidential information. In practice, strong form efficiency is generally considered unrealistic because insider trading laws exist precisely because non-public information can provide unfair advantages. Evidence showing that insiders sometimes earn abnormal returns suggests that markets are not perfectly strong form efficient. Nevertheless, the concept highlights the importance of transparency, disclosure regulations, and fair information distribution in promoting market integrity and improving investor confidence in financial systems. Market efficiency depends on several important assumptions regarding investor behavior and market structure. Efficient markets generally require large numbers of rational profit-seeking investors, rapid information dissemination, low transaction costs, and active competition among market participants. The program notes that even if some investors behave irrationally, arbitrage activities by rational investors may help correct pricing errors and maintain overall market efficiency. However, limits to arbitrage, behavioral biases, liquidity constraints, and information asymmetry may allow temporary mispricing to persist. Analysts therefore recognize that real-world markets may not be perfectly efficient and that varying degrees of efficiency may exist across asset classes, geographic regions, and time periods. Behavioral finance provides important challenges to traditional market efficiency theory by emphasizing psychological biases and irrational investor behavior. Investors may overreact, underreact, or follow herd behavior, causing prices to deviate temporarily from intrinsic values. Market anomalies such as momentum effects, small cap outperformance, value investing premiums, and calendar effects have also raised questions regarding perfect efficiency. The program explains that while anomalies may appear inconsistent with strict efficiency assumptions, many anomalies weaken over time as investors exploit them. Behavioral finance therefore complements traditional efficiency theory by helping explain why temporary inefficiencies may occur while still recognizing that competitive markets often correct mispricing over the long term. Understanding market efficiency is essential for investment analysis, portfolio management, and financial decision-making. The degree of market efficiency influences whether investors should pursue active security selection, passive indexing, or specialized trading strategies. Efficient markets support fair pricing, liquidity, and capital allocation by rapidly incorporating information into security prices. However, analysts must also recognize the limitations of efficiency assumptions and the potential influence of behavioral biases, information asymmetry, and market frictions. The program emphasizes that market efficiency exists on a spectrum rather than as an absolute condition. A strong understanding of market efficiency enables analysts to evaluate investment opportunities more realistically, design appropriate portfolio strategies,